how does insurance float work?
So insurance float works like this. You are an insurance company, and if I'm going to insure your car, for example, you're going to pay me an upfront premium for the year, right? Or or for example, I don't know if we want to include this in the video, but I just insured my Rolexes, right, with State Farm. And
Did you
for
actually?
yeah, yeah. So for the year, I paid, a little less than $500.
Why State Farm, by the way?
It was the best price.
Okay. Good
Yeah.
coverage for luxury goods and items.
Yeah, yeah. I mean, Geico has a subsidiary as well, but their pricing was crazy.
Well, we're making a whole thing about Geico right now, so
I
looks like
know,
you went
right?
the wrong provider. But
Yeah, no. So
anyways,
I forget what Geico's insurance, jewelry insurance subsidiary is, but yeah, they're probably the biggest, one of the biggest names. And then my renter's insurance policy said, oh, the items are too valuable.
so what's a premium?
Yeah. So the premium is the what the insuree, person who wants to be insured, pays up front for that insurance. So they pay a
Upfront
premium.
over, like, is it what they would owe over the course of, say, a year or a month, or what's that premium? What time frame does it cover?
It's typically, most insurance is a year. So you pay a year premium to be
In
covered
advance for the whole year.
in advance of the whole year. And then there's more complex forms of insurance that especially Berkshire plays in. For example, they do something called super catastrophe insurance, or essentially reinsurance, where they actually insure insurance companies.
Right.
So if I'm an insurance company and I'm insuring a portfolio of properties against flooding, but if my aggregate risk hits above 10 billion, I'm going to go to Berkshire and get that reinsured. And because Berkshire is the only company in the world big enough to take on such a single concentrated risk. And so they're playing in big insurance like that. And if you think about it, those
And then you have
insurance,
somebody who can insure Berkshire, or does it just stop there?
it stops with Berkshire. So many insurance companies, they I forget the term, but they essentially take some of the risk off their balance sheet, and they'll sell some of that insurance off, but Berkshire keeps all the risk on their own balance sheet, and that's what gives them that competitive advantage.
Mm.
The other thing about supercat is it's really long range, because if I'm Berkshire and I insure the probability of a hurricane happening in Florida and an earthquake happening in California at the same time, right? That might not happen for 20 years. So I might just be able to collect premiums and premiums year after year, and that's my float. So I collect millions and millions of dollars of premiums that maybe I eventually have to pay out in claims, but in the meantime I have that money and I can invest it, which that's what Berkshire does. They buy stocks and companies, and that's how they're able to compound the float, which essentially allows them to borrow money for free, because if both their insurance business is profitable and they make good investments, then they've just borrowed the money for free.
So what about like a life insurance company, right? Where they're insuring something that may not happen for 20 years or 30 years or 50 years. They have a lot of time to play with that money, essentially. And eventually the person, loses their life. And based on some calculation, they actually probably can pretty accurately predict how old you're going to be when you die based on a number of factors. You're insured, according to that. And then just like Berkshire, do they play with the money in the same way in the meantime? They put it in the stock market, they put it in index funds, they create a portfolio. So they take the money up front that they'll pay out in 20 years, but what you're losing as the customer is you don't get to invest that money. You give it up, you're paying it, and in the meantime you've got this company holding it and investing it on
Yeah,
your
exactly.
behalf, but not giving you any of the cut, right?
Yeah, and one of the major players in real estate debt is actually insurance companies. So they play a major role. Some of the class A nicest properties that you see, their debt is from insurance companies, and that's because, like you said, they've got this long range that they need to do something with the money, and so their return criteria is quite low. So they're able to be competitive in the real estate debt market, loan money at very conservative terms, but it works for them because they're that long range investor in the
Mhm.
market.
So insurance has been an interesting sort of go-to-market strategy for a lot of startups. Not, I wouldn't say a lot. There's sort of a niche of startups. There's a niche of startups that look at insurance as a go-to-market. And what I mean by that is, take Mira, for example, right? We provide a hardware device and software that makes the job of a frontline worker safer. It ensures that they're doing the job correctly. It's documenting using the camera that they're doing the things that they say that they're doing, and eventually using machine learning to detect when they're doing things incorrectly and help them fix those mistakes immediately, right? So you've got some companies that are using Mira, right? They're using this sophisticated digital technology to ensure that these very risky processes that are all insured, right? You have these like highly industrial environments that are certainly insured. Some companies are using technologies like Mira in those environments, and other companies are using pen and paper for those same environments, right? So you can imagine the discrepancy in really what those two customers should be paying from an insurance perspective. And basically the bottom line, the lowest common denominator that everyone is getting charged for is based on everyone using pen and paper. That's what the risks are sort of modeled from. So you have this new kind of flavor of go-to-market from these tech startups that are going to these insurance companies and saying, hey, well, get your customers to use Mira and give them a discount on their insurance premium. And then like that, and then we'll take some of the shared savings or whatever the business model, someone's winning, someone's saving money, right? It's the same sort of thing that a company like Fitbit is even trying to do at a really long scale, which is going through employers to actually give those employees Fitbits. And based on if their habits are healthier, it's encouraging preventative medicine. And so their insurance premiums will go down, and then there's a shared savings model. So it's interesting what tech startups are doing to approach that kind of go-to-market with all of this insurance.
Interesting. Yeah. So cost disintermediation and all that. Yeah, that's interesting. So what we have, what we've talked about a little bit is the Berkshire stuff, which, we've mentioned already, talking about Berkshire Hathaway. For those that aren't familiar, that's Warren Buffett's investment vehicle that he's taken from essentially zero to one of the largest companies in the world, which is just a conglomerate of companies. And there's a lot of lessons to be learned. And so you and I just did a little bit of reading, and we had some discussions that relate to our own businesses and just some interesting insights to share. So let's set the stage. Why don't you kind of walk through because it's fresh in our minds, why don't you walk through kind of the Berkshire model and how, they're shipping cash back to headquarters and what their strategy is?
Sure. So Berkshire Hathaway, you think of it like a fund in some ways, but really they started just as a plain old company. They started with a company with shareholders and a cap table, and it's just a company. And it started with $10 million on the balance sheet. And they basically figured out, we've got $10 million in our bank account. What do we do to multiply this money? And the thing that they really started to do was finding profitable businesses that were typically started and still run by the same founder. And they would buy those companies out, and nothing would change about the operations of that company. They wouldn't, bring in new management. They wouldn't touch anything. The only difference is that the profit that company was making now flows back to Berkshire Hathaway. So they buy these companies that are profitable. The founder loves running them. They figure out these great incentive systems to keep those founders in place with compensation bonuses and all these things, just so they don't have to touch anything. The profit flows back to HQ. They take that profit and they reinvest it in more businesses. They get diversified. They start buying, tech stocks and like Apple or stocks like Coca-Cola. They buy more businesses, Dairy Queen, Geico, and it just kind of goes on and on.
Yeah, that's a great explanation. So and like you said, the really interesting point, which is so different than kind of the go mentality of Wall Street, is investors, especially on the private equity side, are always looking for ways to add value. And they want to buy a company. They want to oust the CEO and replace the board members and new management, new ideas, follow-on acquisitions, mergers. And, Berkshire has the exact opposite strategy. They want to buy something that's great, and then they just want to sit back and do nothing. And it's obviously worked out really well for them. And I think there's something to be said. I mean, sure, there are some times and there are strategies to go in there, kind of like in our business, where we find an underperforming real estate asset. And then, we've been very successful with renovating the apartments, getting higher rents, increasing occupancy, and that leads to real value creation. But other times you can find an asset or a company that's well performing in place, and it really does all the work for you. And so that's what has really allowed them to grow so much in their large size, because something that is said in our reading, that when they first started out, and actually when Warren started out, he was investing under his teacher Benjamin Graham at Columbia, and he taught basically cigar butt investing, where you just go and find a company that's on its last legs and it's about to be a dead company, and then you just pick it up, puff its last little puff of cash flow, and then that's it. But you buy it for so cheap, so it doesn't matter. And so Warren was doing really well with that. But as you can imagine, those opportunities are very small, and the capital that you can put into those is very small. And essentially his partner, Charlie Munger, said, hey, if you want to make it big and you want to do this with billions of dollars, you need to actually, instead of trying to buy bad companies at a great price, let's buy great companies at a fair price and then let them ride forever.
Sequoia has a specific term for those types of companies. They call them enduring companies, companies that endure. I think it's a powerful one. An enduring company. It's not one that, is flipped for cash. It's not one that, is about to die with one more puff in the cigar. It's an enduring company. It's created enduring value in the world that's not going anywhere. And it's an enduring company that has been structured and that's here to stay. And you look at some of the biggest companies they've ever invested in, they've endured. It's Cisco, it's Google, it's EA, it's Apple, it's Airbnb, it's DoorDash. These aren't, cigar puff companies. These are enduring, lasting companies. So I think Charlie Munger sort of hit it on the head with Warren in saying, hey, like maybe rather than kind of looking for the scraps and finding this incremental value that we can kind of, pull some cash out of, what if we invest in companies that are here to stay, the ones that are enduring?
Right. And like I said, investable strategy when you've got large pools of capital. The other really interesting thing that's super unique about Berkshire is really their corporate structure. Like you said, they've got 19 employees at headquarters, yet they have nearly 250,000 employees. And so essentially they have, here it says they have no human resources, purchasing, marketing, legal, or investor relations. None of that.
They've also got it says very specifically, no analysts who find market trends and X, Y, and Z thing. They don't have associates who go and try to find deals. It says that people just used to fax letters straight to Warren, or Warren picks up the phone and says, asks a few questions and very quickly decides if it's a deal worth doing or not. 19 people.
Great. So let's talk about compensation structures, because this is something that I'm super interested in. I think it's really important if you're trying to, run a business or you're trying to invest in a business, the compensation structures have to be right, all up and down, whether, from the CEO down to the, lowest level employees. So kind of what are your high level thoughts about incentives, compensation, bonuses?
In the way that Berkshire does it, or just generally?
Let's start with Berkshire and then we'll go general.
Yeah. So in the reading that we did, it wasn't too specific about the compensation, but what it made very clear was that Berkshire has absolutely no problem incentivizing and compensating their executives, the people that run all the different companies that they own. They have no problem compensating them in really rich ways. And what I mean by that is, if there's a company that they're expecting to, profit $1 billion in a year, they'll have no problem paying the CEO maybe a $50 million or $100 million bonus to hit that profit figure. For the CEO, it's huge incentive to stay and do a good job. It's a life-changing amount of money for them to receive. Yet in the grand scheme of how much profit is going to be rolled back up to Berkshire, we're talking about a couple percentage points here, right? So in Warren's mind, it's kind of like, yeah, I'll give up 2% of the profits to this one guy or one girl, one man, one woman, basically, to basically earn me, $1 billion that I can go put back to work. It's a win-win for everybody. And so he makes it very clear, there's no problem paying out, tens of millions or even hundreds of millions of dollars in bonuses to these people to keep the incentives, right? Because the number one thing he talks about is, well, you go and you buy one of these companies and you buy it for a lot of money. Why wouldn't the CEO just run off with their 50 million or $100 million? Why wouldn't they go, live on an island somewhere for the rest of their life? He says, well, we need to really focus on retaining those CEOs through incentive structures to make sure that they're not going to go anywhere and they're going to continue to, deliver the profits that Berkshire needs for years and decades to come.
Yeah. And the other thing they mentioned is that he feels it's crazy to grant stock options, which have a very volatile value to them. And also, those managers that you were referencing to are compensated solely based on their unit's performance. So they're not being bonused based on the aggregate performance of Berkshire. So if their unit knocks it out of the park, but Berkshire as a whole had a bad year because of, their insurance business and this and that, that's not going to negatively impact that person's compensation. So I think that makes sense. And the other piece that's unique is, so this is kind of a more complex topic or idea to understand, but it's, if you think about a company, let's say a public company, and it's granting its CEO stock options. And the company doesn't pay all of its free cash flow out in dividends. That means it has retained earnings every year, and then it uses those retained earnings to invest back in the business to grow the business. So even if the CEO really does nothing good and just kind of retains the earnings and invests it at, a 2% return on equity, 3% return on equity, those stock options are going to go up in value. So Warren felt that it didn't make any sense that compensation wasn't directly tied to capital employed, right? So the managers would be compensated not just based on the rate of growth, but also the capital that was needed to actually spur that growth. So that is something really interesting, and something that I think in my own business as well with my property managers, because we can't just say, oh, great, well, you raised revenue, but what about expenses?
So let's go back to float and insurance and all that and your Rolex. The first business that Berkshire bought, before they bought a stock, before they bought anything, the first thing they bought was an insurance business because of the float. Help explain why. Why did they buy an insurance business? Why was it? Why was the float simple? Why was that the best form of capital for them to go get?
Yeah. So the insurance business is really interesting because the way that I used to think about insurance was, well, if I'm being insured, I'm paying the insurance company a premium, and they're making a bet, a diversified bet, because they're going to have many people that they insure, that the premiums they collect are going to exceed the money that they pay out in claims, right? That's how you would think they would logically run their business, but that's actually not how they make money. It's really interesting that the way that insurance companies actually underwrite and determine what is an appropriate premium to charge is actually for them to end up having their costs be 110% of the income that they pull in, which doesn't really make sense. And that's also from Warren Buffett's really old letters. And so that may have changed structurally due to the reduction of interest rates over time. Maybe it's 105%. But the idea is they're willing to lose money on their main insurance business because it generates this float, which, as we discussed before, float is the fact that people pay the insurance company premiums up front to then pay out claims in the future. So it essentially creates this money that they can do something with in the interim. And insurance companies, they typically invest it in the stock market, in real estate debt, and so forth to generate a positive return. So the way insurance companies actually profitable is the combination of both, making the underwriting profits if they can, and then utilizing the float to create investment returns. And Warren recognized the fact that if I can generate float at an attractive cost of capital, maybe even turn a profit in the insurance business, that means I'm borrowing money at a negative rate and then able to invest it in the market and compound it through buying stocks like Coca-Cola, which, like you said, an enduring business, has had the same mission since 1800s.
Incredible. Just to relate everything back to tech, of course, there's a tech company that is on fire right now. They're doing really, really well. They just closed a massive Series B at a $2 billion valuation. Some tier one investors came in like Chamath and Mark Benioff, and Blackstone participated. And what it does, it sort of takes this idea of float in sort of a tangential way, right? And it applies it to the tech sector and software businesses specifically. A lot of businesses, as you know, charge monthly recurring revenue, MRR. So like you go and you sign up for Slack, they'll charge you, I don't know, $7 a month, or Zoom, $15 a month. And they charge all of their customers, X dollars per month. Most customers just have, a credit card plugged in every month that charges them. So, Zoom charges you $15 a month. By the end of the year, the ARR, the annual recurring revenue, is $180, right? So every time someone signs up, they know that, they'll make $180 from them that year. And maybe a small percentage of Zoom customers will churn, will basically cancel their subscription at the end of the year. So they can do this big equation and they sort of understand, okay, for all of our subscribers, this is how much revenue we expect by the end of the year based on our churn, based on what our ARR would be for all these customers, right? Pipe is a company that basically came in and said, look, all these companies that are charging MRR, we're actually going to turn it into ARR for that company. So Slack, if everyone's paying monthly, Pipe will basically come and finance all the monthly subscribers on an annual basis and say, okay, well, here's all your money for the whole year. And it's not like Berkshire where they're going to take that money and go invest it in stocks and stuff like that, but it gives them the working capital up front. So now they can invest in more hires, they can do more things for their business. And they basically created this financial tool to basically finance MRR, because there's so much data and so many metrics available around churn, MRR, ARR, all these different things that kind of can plug into this equation. And they've really figured out a new financial tool and system for startups, which is a huge sector financially. Right. And so that's why like a Blackstone went and invested in their Series B, because it's probably interesting to them to start looking at that at scale.
Yeah, I mean, it's a really understandable business coming at it from multiple angles, right? At the end of the day, it's a really simple finance business that's financing accounts receivables, right? These companies are owed something in the future. This company's coming in and making a bet on actually those future receivables being collected, and they are charging an appropriate interest rate that they believe that they're being compensated for their risk. And then, as you said, on the flip side, the company is saying, well, whatever interest rate we're paying for getting that cash up front, we can actually do more with the money now than the cost of that capital.
That's right. That's exactly right.
Very interesting. I did not know about that.
Yeah. Pipe, check them out. I got exposure to the Series B.
Fancy.